There's a version of your life where you did everything right. You got the degree, you got the job, you paid your bills on time, you even started investing. And somehow, at 38, at 42, at 45, you look at your bank account and think, where did it all go? Here's the uncomfortable truth. Most people don't lose wealth through one catastrophic mistake. They lose it slowly, through decisions that felt completely normal at the time, through habits that looked responsible on the surface, through traps that nobody warned them about, because from the outside, those traps look like success. Today, we're going to talk about the real wealth killers in your 20s and 30s, not the obvious ones you've already heard 100 times, the ones hiding in plain sight. I'm Gigi, and this is Gigi Invests. Let's get into it. Section 1. The City Trap. Let's start with something almost nobody talks about in personal finance, and that's the city you live in. Where you live is not just a lifestyle decision. It is one of the most consequential financial decisions you will ever make, and most people make it by accident, based on where they grew up, where their family is, or where rent seemed manageable at 22. Here's the problem with that. If you're in a city where the industries don't match your career path, or where salaries are structurally lower, you're not just earning less today, you're anchoring every future salary negotiation to a lower starting point. That gap compounds for decades. Let's make this real. The median household income in Kansas City is around $69,000 a year. Move to Austin, and that jumps to $90,000. San Francisco is over $135,000. Now, yes, cost of living rises too, but if you manage your expenses intelligently, the salary gap is real money you're leaving behind every single year. And it's not just the paycheck. The city you live in shapes your network, who you meet at industry events, who refers you for opportunities, who introduces you to investors or partners. That's all location dependent. The people around you set the ceiling for your ambition. Ambitious people cluster in certain cities. That's not a coincidence. Now, here's what that advice misses, and it's important. This is not a one-size-fits-all rule. If you're in healthcare, skilled trades, or certain local professions, a rural area might actually pay you more and cost you less. A dentist in a small town can earn $400,000 working 4 days a week. A nurse practitioner in rural Montana can earn significantly more than one in a saturated urban market. So the real principle isn't move to a big city. The real principle is this. Wherever you are, make sure your location is working for your career, not against it. If you're in a place where your field is underpaid and underrepresented, that's worth taking seriously. If you're new here, this channel is about building real wealth without the noise. Hit subscribe so you don't miss what's coming next. Coming up, we're going to talk about a money habit that looks like financial responsibility, but is actually quietly costing you thousands every year. Most careful people fall into this one. Here's a wealth killer that targets the most financially responsible people in the room. You've heard the advice. Keep 3 to 6 months of expenses in an emergency fund. That's standard. That's smart. But here's where it goes wrong. A lot of people, especially in today's economy, where layoffs feel unpredictable and job markets feel unstable, end up keeping 12, 18, even 24 months of expenses sitting in a savings account. And emotionally, that makes complete sense. It feels safe. It feels like protection. But financially, there's a cost to that safety, and it's called opportunity cost. Here's the math. Say your monthly expenses are $4,000. A 6-month emergency fund is $24,000. A 16-month fund is $64,000. The difference is $40,000. Now, that $40,000 sitting in a high-yield savings account at roughly 4% is earning you around $1,600 a year. The same $40,000 invested in a diversified index fund at a historical average of 8 to 9% could grow to over $185,000 in 20 years. The gap between those two paths is enormous. Now, viewers of similar videos have pushed back on the standard 3 to 6 month rule, and honestly, that pushback is fair. In 2025 and 2026, job markets in some sectors are genuinely volatile. Tech layoffs, corporate restructuring, the gig economy, these have changed what job security means. For a lot of people, especially those in unstable industries or with fewer immediate family safety nets, 6 to 9 months is a reasonable updated target. But here's the line. Beyond 9 to 12 months in cash, you're likely not being cautious, you're letting fear make financial decisions for you. And fear is an expensive advisor. The fix is simple. Define your number. Calculate your actual monthly expenses. Multiply by 6 or 9 if your industry warrants it. Park that amount in a high-yield savings account and call it done. Everything beyond that threshold should be invested, not sitting idle. This next one is uncomfortable, but it's too important to skip. Who you build your life with is, financially speaking, one of the most significant decisions you will ever make. Not because relationships are transactions, they're not, but because the financial consequences of getting this wrong are severe and long-lasting. The U.S. has one of the highest divorce rates in the world. Roughly 40 to 50% of first marriages end in divorce, and the rates for second and third marriages are even higher, around 60 and 73% respectively. Despite this, only about 15% of couples sign a prenuptial agreement. Now, the obvious cost of divorce is the legal process itself, which can run $20,000 or more, but the real financial damage is in the hidden costs. A shared home often has to be sold or refinanced, sometimes in a down market, sometimes at high interest rates. Retirement accounts accumulated during the marriage must be divided, and doing so requires specific court orders. There are moving costs, asset splits, and if either partner owns a business started during the marriage, that can become extremely complex and expensive. When you add it all up, including legal fees and financial restructuring, divorce can cost anywhere from $50,000 to over $100,000. And the rebuilding period is equally costly. Two incomes become one, shared expenses become individual, housing, insurance, childcare, everything restructures at a higher per-person cost. Here's what most personal finance videos won't tell you. The financial risk of a bad partnership isn't just divorce. Financial incompatibility within a marriage is just as destructive. A partner with high interest debt, compulsive spending habits, or fundamentally different money values can quietly drain wealth for years without the relationship ever formally ending. The actionable advice here is this. Before committing to a life partner, have direct, honest conversations about money, debt levels, spending habits, financial goals, risk tolerance. These conversations are uncomfortable. Have them anyway. Many couples also benefit from premarital financial counseling, not because something is wrong, but because alignment on money is one of the strongest predictors of long-term relationship stability. A prenup is also worth considering, not as a sign of distrust, but as a legal document that protects both people and makes expectations clear from the start. If this is landing for you, take 2 seconds and hit the like button. It genuinely helps this channel reach more people who need to hear this stuff. After the break, we're getting into the wealth killer that's probably affecting your paycheck right now. And no, it's not how much you spend on coffee. There is a version of financial ruin that looks from the outside like success. New car, nice apartment, designer clothes, regular vacations documented on social media. It's a curated image, and it's one of the most effective wealth traps of the modern era. The behavioral economics term for this is social comparison, and study after study confirms what most of us already know intuitively. When we compare our financial situation to what we perceive others to have, we make worse financial decisions. We spend more. We save less. We take on debt to maintain appearances. Here's what the highlight reel hides. That car might be leased. That apartment might be consuming 50–60% of someone's take-home pay. Those clothes might be borrowed or purchased on a credit card that hasn't been paid off in months. The vacation photos were taken on a trip funded by debt. The people who look wealthy are very often not wealthy. The people who are quietly building real wealth very often don't look like it at all. This is one of the most consistent findings in research on high net worth individuals. They drive average cars, live in modest homes, and don't broadcast their finances. The practical step here isn't to become a hermit or stop enjoying your life. It's to build a financial identity that's defined by your own goals, not by what you think your peers expect of you. That means knowing your numbers, having a budget that reflects your values, not your image, and being honest with yourself when a purchase is driven by status rather than genuine utility. Social media will always show you the edited version of someone else's finances. Your wealth is built in the version nobody sees. This next point applies directly to anyone working at a startup, a public company, or any employer that offers stock-based compensation as part of their package. When you negotiate a job offer, you're often choosing between two things: a higher base salary or more equity in the company. Most people, especially early in their careers, choose the salary. The cash is immediate, predictable, and feels real in a way that stock options don't. But here's the thing about equity. A single, well-timed equity outcome can exceed an entire decade of salary. That's not hypothetical. It's what happened for thousands of early employees at companies like Google, Amazon, Salesforce, and more recently, companies like Airbnb and DoorDash. Now, before you take that too literally, let's be clear about the risk side of this. Startup equity is highly speculative. The majority of startups fail, and equity in a failed company is worth nothing. Even in successful companies, equity often comes with vesting schedules, lockup periods, and tax implications that aren't obvious at the time of signing. Taking equity over salary makes the most sense when you have high confidence in the company's trajectory, you can afford to take a short-term cash reduction, and you understand the terms. Specifically, what percentage of the company your shares represent, not just the raw number of shares. A comment that comes up often on this topic is a fair one. Taking equity over salary is sometimes compared to gambling, and in a pure startup context, that comparison isn't entirely wrong. Where equity really shines is at established or mid-stage companies with real revenue, real growth, and a realistic path to liquidity. If you are evaluating equity, do two things. First, find out what percentage of the total outstanding shares your grant represents. The raw share count alone is meaningless without that context. Second, estimate a realistic valuation range for the company and apply your percentage to that. That gives you a rough expected value to compare against the salary trade-off you're being asked to make. Stay with us. The next two wealth killers are ones that most people in their 20s and 30s are experiencing right now and don't even realize it's costing them. One of the most expensive things you can do with money is wait for the right time to invest it. This feels like caution. It feels responsible, like you're being smart by waiting for the market to dip, or for things to stabilize, or for your financial situation to feel more settled. But the data on this is clear and consistent. A hypothetical $10,000 invested in the S&P 500 from 1996 to 2025 would have grown to over $192,000 if you stayed fully invested the entire time. Miss just the 10 best trading days in that nearly 30-year period, 10 days out of thousands, and your gains drop by 56%. Miss 20 days, and you're looking at 74% less. Miss 30 days, and you've lost 84% of your potential gains. The problem is that the best days in the market are completely unpredictable. They often come right after the worst days, during moments of maximum fear, when most people are selling, not buying. The investors who try to time the market miss exactly those recovery spikes. This is not an argument to invest recklessly or to ignore your personal financial situation. If you have high-interest debt, that should come first. If you don't have any emergency fund yet, build that before investing. But once those foundations are in place, waiting on the sidelines is not a neutral decision. It's a costly one. The most reliable strategy, supported by decades of research, is consistent and automatic investing. putting a fixed amount into a broad index fund on a regular schedule, regardless of what the market is doing. This approach, called dollar cost averaging, removes the emotional decision-making from the equation entirely.
Here's a wealth killer that hides behind a virtue: loyalty. Staying at a job because you're comfortable, because you like your colleagues, because switching feels like too much effort, these are all legitimate human feelings. But financially, they can cost you significantly over the course of a decade. Here's the pattern. You graduate, you get a job at $60,000. Your employer gives you a 3% raise annually. You stay for 10 years. At the end of that decade, you're earning around $80,000. That sounds like progress, and it is. But it's slow progress. Now consider this. According to research from LendingTree, workers who switched jobs saw their earnings jump by over 11% on average, with some seeing gains of 30% or more. The reason is simple. When you switch employers, you reset your salary negotiation from scratch. You're not asking for a raise within an existing structure. You're setting a new base. Over a career, those jumps compound. Someone who starts at $60,000 and switches strategically every 2 to 3 years, moving laterally in title to gain pay or laterally in pay to gain a better title, can realistically be earning $120,000 to $150,000 by their mid-30s. Someone who stayed loyal at the same company might be at $85,000. The important caveat here, and this comes directly from people who've thought carefully about this, is that job hopping has a hidden cost: your 401k vesting schedule. Many employers require you to stay for 2 to 4 years before their matching contributions are fully yours. If you leave before that cliff, you leave that money behind. Factor that into the timing of any switch. The broader principle: know your market value. Check salary data on sites like Glassdoor, Levels.fyi, or LinkedIn regularly. If there's a significant gap between what you're earning and what the market would pay you elsewhere, that gap is information worth acting on. We can't talk about wealth killers without talking about high-interest debt, specifically credit card debt. The average APR on credit cards in 2026 is 22.11%. That number is not a typo. It means that if you carry a $10,000 balance on a credit card and make only minimum payments, you're paying roughly $185 every single month in interest alone. That money is gone. It's not building anything. It's not investing in anything. It's the financial equivalent of paying rent on debt you already owe. And the compounding effect works against you just as powerfully here as it works for you in investing. Every month you carry that balance, the interest charges grow. The hole gets slightly deeper. The distinction worth making is between productive debt and destructive debt. A mortgage on a home that appreciates over time, that's a tool. A student loan for a degree with strong earning potential, that can be a tool too, though it's worth being careful here. High-interest consumer debt, credit cards, payday loans, personal loans above 10%, these are rarely tools. They're almost always wealth killers. If you're carrying high-interest debt right now, this is the financial priority above almost everything else. The guaranteed 22% return you get from paying off a credit card balance outperforms virtually any investment you could make with that same money. The last wealth killer on today's list is one of the most visible and one of the most emotionally charged: cars. The average price of a new car in 2026 is over $51,000. At typical financing rates, that's a monthly payment of $750 or more. Add insurance, averaging $150 to $200 a month depending on your state and driving record. Add maintenance, fuel, and the depreciation that begins the moment you drive off the lot. The true cost of a new car is often well over $1,000. Invested at an 8% average return instead, $1,000 a month over 10 years becomes over $180,000. Now, that argument has a flaw, and it's worth acknowledging. Most people need a car. The comparison isn't new car versus investing. The real comparison is new car versus reliable used car. Here's where it gets practical. A well-maintained used car with 30,000 to 50,000 miles typically costs $200 to $300 less per month than a new equivalent. Your commute stays the same, your life stays the same. The only difference is the label on the car and whether it's carrying a full new car depreciation hit. One thing viewers have rightly pointed out:
The used car market has tightened in recent years. Post-pandemic supply chain issues pushed used car prices up significantly, and interest rates on used car financing can actually be higher than on new vehicles in some cases. So the math isn't as clean as it once was. That said, the principle still holds. Buying a 3-year-old vehicle with reasonable mileage from a reliable manufacturer still generally beats the financial case for buying new. And if your circumstances allow, if you live in a city with good transit infrastructure, reducing your dependence on car ownership altogether is worth seriously considering. The core message is this: don't let a car payment become the reason you can't build wealth. A vehicle should take you from point A to point B reliably. Beyond that, every additional dollar you spend on a car is a dollar not working for your future. Here's the thing about every wealth killer we talked about today. None of them announce themselves. Nobody sits down at 25 and thinks, I'm going to make a decision today that costs me $100,000 over the next 20 years. These things happen quietly, in choices that feel normal, even smart, at the time. Staying in a city that limits you, keeping too much cash out of fear, marrying without financial alignment, spending to match an image that isn't yours, taking a salary when equity was on the table, waiting to invest, staying at a job that stopped growing you, letting high-interest debt compound, driving a car that costs more than your savings rate. Here's the good news. Awareness is the first step. You don't have to get everything right at once. You just have to start making decisions with your future self in mind. Pick one thing from today's list that applies to you, just one, and figure out what it would look like to change it. Not someday, but this month. That's how wealth is actually built. Not through one big decision, through small ones, made consistently over time. I'm Gigi. This is Gigi Invests. I'll see you in the next one. If this video gave you something to think about, share it with someone in their 20s or 30s who needs to hear it. And if you haven't already, subscribe. New videos go up every week, and every single one is built to give you an actual edge. See you next time.